What's up, guys? It's your boy Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Fastly, ticker symbol FSLY, trading for $80 a share as of August 7th, 2020, equating to a market cap of $8 billion. It's been a crazy ride for Fastly investors, as the company is up a whopping 263% in the last 6 months, but still down 31% from its highs seen earlier last week when the company was trading for $116 a share. So what's the move? Are we living in the fast lane? Or is the company fastly running out of steam? This is your quick stock analysis. Fastly is an American cloud computing service provider. Fastly's Edge Cloud platform provides content delivery network, internet security services, load balancing, and video streaming services. It only feels right to start with Fastly CDN service. Bear with me, I promise it's not as complex as it sounds. First of all, CDN stands for Content Delivery Network, and they work by accelerating internet content delivery. Typically, when you access a web page, your device needs to connect to the location where the web page's server is hosted. So if you're accessing a web page, every time you make a request, your device needs to connect to a server that is potentially thousands of miles away. And generally, the further the range, the longer the request will take. Fastly offers powerful POPs, or point of presence, where web page data can be retrieved from various points throughout the globe, meaning data can be collected from the closest POP as opposed to the host server, vastly increasing load speeds. And unlike legacy CDNs, which may have hundreds or thousands of small servers around the globe, Fastly uses fewer, more powerful servers strategically positioned at well-connected locations. Their network consists of 18 points in North America, 2 in South America, 8 in Europe, 5 in Asia, 6 in New Zealand and Australia, and finally 1 in Africa. This gives Fastly an advantage because their servers can cache more content, meaning fewer requests are sent back to the original host. Sources say that 25% of users will abandon a website that takes longer than 4 seconds to load, and 46% of users will not return to poorly performing websites. This means that Fastly's platform could be the determining factor in whether or not a customer makes a purchase, or whether a user returns to a given website. Since the company focuses on an open source software that offers a ton of low-level control for hosts and developers, and as an additional bonus, this network also offers security benefits, including protection against DDoSing, which has become incredibly popular as it takes little skill but can do plenty of damage to a website. With little more than a quick Google search, a DDoS can effortlessly direct massive amounts of web traffic to a site, dramatically slowing it down or taking it down entirely. A quality CDN such as Fastly is built to analyze and absorb unusual traffic spikes, which can either be attributed to valid events such as marketing promotion, in which case the request will be serviced, or identified as spam. Another benefit of Fastly's platform is that it allows for instant purging, meaning that when a website's content is updated, old information is quickly replaced with new information. This ensures users are always accessing the most relevant content. This is especially important for sites where information can change rapidly, such as Airbnb, Etsy, Hotel Tonight, Ticketmaster, Twitter, the New York Times, or Shopify, all of which are Fastly customers. And of course, Fastly is also working on Computing Edge, which further improves its CDN with even faster and optimal user experience. Fastly's Compute Edge enables developers to build applications that utilize the edge to process code. While serverless is something of a misnomer, as it still involves servers, the term refers to the idea that a server is used only when needed, essentially offloading the heavy computing necessary for various applications to function on a device. This differs from traditional models where a server is continuously in use. However, an investor should remember that Fastly is still a small player in the CDN market, and the edge computing market is only just gaining traction, but both are expected to grow quickly in the upcoming years. 75% of enterprise-generated data will be processed by the network edge by 2022. Their total addressable market will reach $35.5 billion by 2022. And more aggressive estimates predict that the CDN market will reach $49 billion by 2025, representing a 27% annual growth. Another estimate puts the CDN market at $110 billion by 2027, representing 32% annual growth. Likewise, the edge computing market is estimated to reach $16.5 billion by 2025, representing 33% annual growth. Of course, these are only estimates. The key point is that Fastly operates in a quickly growing market. However, pump the brakes. Despite the potential upside, there are still several risks that investors should be aware of. Fastly is neither profitable nor cash flow positive. If they continue to burn cash at present rates, Fastly can operate for about 4 years before they need to raise additional capital. Along with this, what is stopping its competitors from creating their own CDN? Well, nothing. Google and Amazon already have their own CDN, but Fastly does have certain advantages. For example, Fastly is cloud agnostic, meaning it can operate on any cloud network, which may make it preferable to Google or Amazon, who have their own central clouds. This leads some investors to speculate on one of the behemoths buying or investing into Fastly. And while it is certainly possible, remember, Fastly has numerous competitors, many of whom generate more revenue and have a larger customer base. Another important note is the potential ban of TikTok, which is huge. Remember, in the last 6 months, TikTok made up 12% of the company's revenue. Granted, less than half of it was in the United States. Overall, it's a shame, as it caused quite the correction in share price, even after reporting better than expected earnings, with $75 million in revenue and a positive EBITDA, with a strong balance sheet and liquidity. And on top of this, the company stated that next quarter they should have a positive earnings per share. Even if it is just razor thin, it is a step in the right direction. The company has shown strong demand for its products, as revenue grew roughly 39% in 2019 and 38% in Q1 2020. Gross margins have consistently been in the mid to high 50% range. But throughout this growth, Fastly has not been profitable, nor is it cash flow positive. Fastly lost 75 cents per share in 2019 and posted an operating cash flow of negative $31 million. However, Fastly has a relatively strong balance sheet with $116 million in cash, which means the company could operate for a few years without the need to raise additional capital. So with all of this in mind, what's our move? Well, let's be real, the company is trading for an incredible premium. Fastly is trading for 30 times this year's expected revenue and 23 times next year's. That is extremely high. Those are typically the ratio for price per earnings, not price for sale. At these premiums, investors are banking on technology that hasn't yet been created and revolutionary advances in this market in the upcoming years. After all, for fiscal 2020, the company is projecting $30 million in revenue. Of course, still a net loss from a net income standpoint. And yet the company has a market cap of over $8 billion, which is bonkers. But I'll be real, we are in a changing landscape. However, what's less certain is if Fastly will grow into one of the dominant players. Along with the insane valuation, it makes this an extremely speculative play. However, the thing is, in many ways, Fastly is the best option for these large enterprises, which offers a huge catalyst for the company. Realistically, we'll have to look into its competitors before making our move, but we are extremely impressed with Fastly thus far. Anyways guys, that's all we've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 1,100 subscribers and plan an early retirement. I will catch you guys in the next one.